CNOOC, China's largest offshore oil producer, is now officially even bigger. That's after completed its $15.1 billion acquisition of Canada's Nexen. So what's next for the state-owned enterprise? One priority should be fixing up its new purchase. The Canadian firm swung to a $6 million loss for its latest reporting period. That's after yet another impairment charge. CNOOC has already stepped up to backstop its acquisition, giving an unusual parent-to-subsidiary debt guarantee of $4 billion. Nomura suggests that while this won't change the consolidated firm's value, it does effectively transfer that cash from the CNOOC parent listing in Hong Kong onto the Nexen listing in Canada, something investors should note. CNOOC also has to consider how much it'll invest in Canada. To get the deal inked, the Chinese firm promised officials it would continue pumping money in, but that was made on the premise of high oil prices. So will they stay elevated enough to justify additional spending? Platts oil analyst Vandana Hari says yes.
Barring any major upsets in the, let's say, the Eurozone economies, I would imagine prices would more or less remain around the current levels.
Shares in CNOOC have been under pressure since the Nexen deal was announced. They're down nearly 20% this year so far. But market watchers also look confident on its prospects. The majority of the 30 analysts tracked by Reuters who cover CNOOC rated a buy or a strong buy. Only 3 are negative on the stock. And investor interest in the commodity names may pick up as we head into Q2, with the energy sector a better pick in Asia than mining, according to Cesar Masri, regional strategist at Goldman Sachs.
Energy tends to trade a little bit more of the global cycle, which we've certainly already seen some improvement on, as well as our energy analysts do see a little bit of pickup in the refining margins.
So while CNOOC has more than its fair share of work ahead, those buying into the oil player will find themselves in good company.